Okay, today we're going to get into a video series for the 2022 housing market predictions. And our topic today is the massive equity drawdown we're going to see due to equitable credit. All right. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Hope you're doing well. It's my first video for the new year, so wishing everybody a happy new year. Lots of success and home ownership dreams for 2022 and beyond. So, as I mentioned, we're really going to get into some things that are going to happen this year that's going to start the change in the housing market and the housing cycle. So really, it's housing market predictions. This is my first prediction for the new year. We're going to do a series of videos here, and as I said, today is really based on what's going to be what's called, like, I guess, a massive equity drawdown. Why? Because all we hear in the mainstream media news is the trillions and trillions of dollars that we have available to us in our home's equity. So clearly, with house price appreciation going up double digits in pretty much every metro across the country, we're roughly, 40 some odd percent, 45% greater than we were at the previous peak in 2006, according to Case-Shiller. So lots of potential money there that can be tapped into, which is a good thing for homeowners, but also problematic for the market and eventually for homeowners as well too. And really, the issue is going to be, well, only a certain percentage of people can probably tap into that market. With so much money available, we're going to see some changes happen probably starting this year. So this just came up in December. It's from Dr. Housing Bubble, and really, everyone now is sort of looking at this. Home equity withdrawals are back on the menu. If you remember back in the last housing crisis, when things kind of fell apart, obviously the mortgage meltdown, subprime mortgage crisis was sort of the catalyst that started all the issues, and people still blame the mortgage meltdown on the subprime loan problems. But really, what caused the main issue with the last housing market is the fact that people did cash out refis, and they used home equity lines to pull their equity out of their properties, not thinking that they'd have to pay that back, or thinking that appreciation would still continue to rise and would cover what they pulled up. So if they sold, they'd at least break even, or they'd make money. So nobody ever anticipated that, hey, once you take this money out, you owe it, and it's got to go back somehow to the house, or you're going to be kind of stuck. That was the main driving force of the last housing crisis. And it looks like we're kind of teeing up for this right now. So we're going to see articles that are basically going, well, where are we at with respect to equity withdrawals? Well, it started, the past couple years, and obviously we're going to see more and more of that as time goes on. And why this could be problematic is because when you're in an appreciating market that has low inventory, so if you're looking to either upgrade a house or downsize, but you're stuck, well, what are you going to do? Well, you're going to pull money out of your property, because are you going to improve it or use it for other ideas? Who knows? Also, with respect to, and I just saw this today, that we have a record number of unemployed people that are choosing to be unemployed, even though there's something like 10 million jobs available. The amount of jobs that came on the last month are very, very low. So it's almost like people are using their equity in their house like they did before to sort of fund their life or their lifestyle, or how they live. And at some point in time, it has to be paid back, or appreciation has to continue to sort of overtake what you've taken out. So basically, there's talking about, the HELOC machine is back. The author here is calling it what they call a Minsky moment, and a Minsky moment is a sudden major collapse of asset values, which marks the end of the growth phase of a cycle in credit markets or business activity. So we're kind of at that point where we're transitioning right now. Will assets collapse this year round? Well, it depends on what collapse means to you. Ultimately, what they're saying, the fact that, the public views, if you join the party right now, you get the reversal of fortunes, and, we're in such a, whether it's Bitcoin or stocks or whatever, everyone's euphoric about, home price appreciation, everything else that's going on in the economy, even though there's inflation. When values are up in all asset classes, people tend to be more risky, or they're less risk adverse, and start to do things because they think they can make money and roll the dice, etc. So this is why essentially they're saying that the HELOC machine is back, because people will tap into their homes for other things, right? To venture into crypto, to venture into stocks, to do other things, buy cars, do whatever. It's that temptation again, because we have so much available due to the home price appreciation. So if you take a look at this chart here, should be the next slide that comes up, you can see that obviously in 2005 we had a pretty big equity withdrawal back then, and we're approaching that. So we're getting probably around 60 billion as opposed to about 100 billion back in the day. So it's getting there. This is what's happened right now, and we still got more to go. So when you think about that, if the house values are greater than the last housing peak, then we can see this year that that line will surpass 100 billion of equity withdrawals and continue as far as it possibly can. So this is why this is concerning to a lot of economists that are out there. Again, going back to the housing narrative, people don't talk about this. So everything is great. You can refi, etc., all these good things, but no one really speaks about the other methods like home equity line of credit to pull money out and the consequences, or when it's time to pay the piper. That's what really is not talked about. And I love how they say, the HELOC trend is worrisome because Joe and Karen, or maybe I thought it was Kevin and Karen, but most of their wealth is in housing. That's the problem now. We've had such a massive growth that people's net worth is tied up in their home. So tapping money out of housing is not typically a smart move. This also shows a weird notion that the gains of the last 2 years are unsustainable. Are sustainable, but they really aren't. So people are thinking, well, we've had these great gains very quickly, it's going to keep going up. That's part of the bubble concept theory. People get relaxed and they believe that nothing can stop this, which puts them in trouble. Obviously, the past year we've had PPP, COVID relief, stimulus checks, a whole bit. So a lot of free money's been floating around. The government's been printing money, so things really haven't been as bad as they could be. So we just keep seeing values going up. So and the point here is that why work when you can simply tap $100,000 out of your property each year? Typical U.S. family makes $67,000 a year before taxes. So just imagine how it feels for them when someone's sitting on their butt is making that much just by sitting in their home. So that's why the temptation is going to be too great for some people to access that money. And again, it's something that's not unsustainable. Usually has a horrific ending at some point in the future. That's kind of what I think is going to happen here, because we're going to see some changes this year, but it really boils down to equity plays and what you're going to do with that equity. And it's surprising how people think with respect to what they think their home is worth, et cetera, et cetera. And this example, look at this. So here, this is a closed sale we did, and clearly, and this is a great opportunity of why, look at, we bought this property. Again, a client partner of mine bought the property. This is a great short sale. We took it out nicely, and there's a huge equity there. So this is an example of the fact that instant equity, if you do good deals, you could have the wherewithal to mess around and do things with your home. If you want more information, stuff like this, definitely drop me a line and we can go from there. The key, though, to moving forward is having the data. And again, go to gethousingdata.com. That's gethousingdata.com. You can look for distressed properties where you can create this equity. So equity, is great based on home purchase price and having everything grow. More equity is available when you're getting distressed properties and using them to leverage and fix up and put back on the market to either refi or sell, etc. So that's the scoop. And by the way, if you're not already a subscriber, please subscribe to my channel. I'd really appreciate it. Obviously, I'm losing subscribers every day still, so anything you can do would certainly help. All right, guys. Enough of the housekeeping stuff there. So getting back into the sort of HELOC here. So I talked about this about 6 months ago, because this article came out from Mark Hansen. He's I guess an analyst, economist type guy, back in July, and I did do a video on this back around that time frame. Obviously, where we are 6 months or more going forward, it's even bigger equity opportunities now. So he's saying the biggest opportunity in the history of credit, fintech, and proptech, a home equity withdrawal mega super cycle meets a 2002 to 2006 style credit easing cycle wrapped in financial inclusion, education, and wellness blanket. All right. So this is really why it's kind of important to talk about this. So basically, are you positioned for the next 5-year massive home equity withdrawal and credit easing super cycles? Well, the present $23 trillion in home equity is so massive, timely, and opportunistic, and it's 100 larger, greater than the 2007 values, right? So again, this is going back in July. So Black Knight saying the average homeowner could tap into $153,000 in equity, up 16 grand from 2020 Q4. So we can see that everything is increasing in value. There's no doubt about that. We know that overall mortgage debt now only represents 48% of home value. So as values increase, the loan to values drop. So therefore, gives you more opportunity to do equity withdrawals from your property. So certainly something to be aware of. But this is what's going on in the industry right now, and it's funny because what he's sort of saying in this article is that think about that for a moment: a $23 trillion in untapped home equity, plus a credit box effectively as loose as 2002 2006. Well, that's when all the subprime and different mortgages, no doc, no income mortgages came into play because things were growing and lenders wanted to lend. This adds up to an impending equity withdrawal supercycle that will make 2002, 2006 look tame by comparison. Well, what he's basically saying now is that, you see, right now, credit is tight. So, and where we're going with the world and narratives and stuff, I'm not making any sort of political statements here. I'm just saying this is where things are trending now. So we're looking at equity or equitable, access to everything for everybody, regardless of where you are, who you are, what you look like, who you subscribe to, and your religion, whatever. It doesn't matter anymore. They're basically, it's like everybody should have the same access to all the products that are out there for mortgage and stuff like that, which is fine and dandy. I have no problem with that. But what they're going to be doing, though, is they're going to sort of push that down the path where you'll have people who are maybe a little more credit challenged or economically challenged be able to tap into their homes, and maybe that's going to help them for a short term, but maybe it's not a good long term thing. So that's kind of where they're doing here. So you got buyer sentiments down. You can't really buy properties because of low inventory. So if that's the case, what are you going to do? You're going to say, well, I'm stuck here. Either I'm going to improve my home, so I'll draw money out and improve my home, or I'm just going to draw money out because I can't sell anyway. I might as well have a good time, right? So basically, we're going to enter the super cycle happening, starting this year most likely. Even if rates go up, the temptation to take money out when you don't have it will be greater than the rates, etc. All right. So basically, there's never been a larger and opportunity to involve credit, housing, and related technology than helping tens of millions of Americans with trillions in equity who live paycheck to paycheck or worse, exasperated by COVID, extracts trillions in found money with home equity. You see. So basically, it's an opportunity to reset your life by taking money out of your property, and off you go. Think about this. The government and Fed have already spent and printed trillions of dollars on COVID. Both are spent out. So unlocking the home equity line is another source of opportunity for wealth. Okay. So basically, he's saying, yes, it sounds like a redo of the bubble years of 2002 to 2006. I think that's inevitable, but much more powerful this time around. Capital always flows to where it's needed the most and gets the best risk-adjusted return. So this is important right here. Equity extraction first, second, and participation products down to 500 FICO scores will attract an ocean of institutional and opportunistic capital over the next several years that lifts all boats. So, if you put things into perspective, what's going to happen is, right now we're seeing some interest rates rise. We're going to see, we have credit tightening that's going on here, but that's not equitable for the housing market and people who want to participate in it. So as we see certain, we'll call it, I guess you could say, trends or what's been normal over the years shift and change the other way to make it much more open. That's where the point, though, you're going to have people who need the housing money to live on, and they're going to extract. And obviously, capital people are going to come in. They're going to make it easier to get the money, which in turn puts more people at risk for future issues down the road. And that's the big concern here. We saw back in the last housing crisis, everything is a repeat. Everything is a cycle. That's why when I sit here and I think about what's going on in the world with housing, I know that a lot of stuff we're going to see now or already have seen and started to manifest just like it happened 10 plus years ago. But it's going to be different this time. Well, not really. There's more players and there's maybe different preordained outcomes than what we had before, okay, by the people who run the markets, essentially. So what does this mean ultimately as a summary here? Well, we're going to see massive equity drawdown. That much that much volume and value of home equity is going to be too tempting for people to let it sit there and do nothing. Okay, and also they think, well, if there is a market change, we do see a slowdown, I better take it out now before it goes away and I don't have access to it. So it's kind of like a little bit of a timing issue too. So that's why we're going to see this happen fairly quick. And great, so massive equity drawdown and greater access, credit access to the equity. And that means that we'll see more loan or capital companies offering home equity lines of credit or other drawdown methods. They're going to probably have less barriers to entry, and they're going to have less credit score requirements to get at your equity. Because in the end, it's your house, it's your equity, and why is someone telling you can't have access to it, right? It's not fair, it's not equitable, whatever. So however you want to argue that, I don't care. But the point is that this is what's going to happen, and that's going to open up a lot of doors. Now, it's going to help people. Maybe it can, but again, any equity drawdown comes with the caveat that it has to be paid back at some point in time. And if we're already seeing sort of house prices plateauing in many areas, and the expectations are we're going to see slowdowns, we're going to see the start of home price depreciation or deceleration of appreciation started. So we'll see some of that happening this year. Couple that in with people who are pulling money out, that's going to cause some problems down the road for a lot of people, just like the last housing crisis. So that's how I kind of see it. This will put homeowners and properties at risk, and it's just like using homes like ATMs once again back in the day. It's too tempting for people, and we'll see how that happens. I still kind of wonder going, well, if we have 10 million good-paying jobs available and people are choosing not to work, where are they getting their money? So chances are they're looking at, well, we're living in a home that we bought for $250, it's worth $500 now, or $400, whatever the number is. We can refi, pull cash out, or we can do whatever, home equity lines. That gives us some short-term play money to invest in other things that are risky, stocks, crypto, whatever, and maybe support our lifestyle until I decide to get a job or new employment, whatever. So again, a lot of stuff in play here, a lot of stuff going on, but I do think this is really interesting. And so I guess that's kind of my prediction, is that we're going to see a lot of that coming up starting right now in 2022. And it's going to help people in the short term, but in the end, this is typically a long-term issue down the road with respect to when it's time to pay and property values have decreased. Remember, if you're pulling 80% LTV or you're topping up to 80% LTV loan to value, if there's swings in the marketplace when you sell, everybody doesn't think of the selling process. But when you sell, well, to get that, and this is what people don't really get involved with and really put on paper, because we hear all the talks about, there'll be no foreclosures, why people just sell because of all this equity. Well, if you want to sell and get all this equity, that means you got to be selling at the top of the market, number one. Number two, your home has to sell like a premium home to get the premium equity. A lot of people who are facing some situations don't have the cash to put new roofs on, to put a new kitchen in, to improve the house, and many can do curb appeal, whatever, you see. So that money has to be paid to put your home into that strata where it can be sold. Then when you do a transaction, you're going to have closing costs and commissions. So, when you start looking at what you got to put into it and you back out closing costs and commissions, like what's the net you're left with? You have to be really careful when you start doing the math. So all this equity seems really good now. When you start working the numbers backwards, it's not as much. You don't actually get as much as you think you have. That's kind of the point here. So just keep that in mind. So this is where I see some of this going. This is going to be one of many factors that are going to play into the housing market starting this year. As I mentioned, there are two housing markets going on. This is really obvious. This retail market that's going to continue to sort of mess around, and we'll see it'll have subtle changes based on mortgage rates changing, based on values, maybe decelerating a little bit, slowing down based on inventory. And again, that's the mainstream retail market. And then we have the shadow inventory, which is the off market, distressed market, things like that, that up until, really have not made an impact or a dent to the overall housing market because it's not been allowed to. So as 2022 rolls in, we know that lenders and their attorneys are going to start filing foreclosures more aggressively. They're going to start taking the cases more aggressively. We're going to see more stuff going to foreclosure auctions, whatever. So that's going to change some of the dynamic of the marketplace as well too. We haven't seen the impact of that yet because it's been controlled and restricted from us based on moratoriums and policies and things like that. Well, guess what? Now we're into 2022. Most of the stuff has been lifted and released. You've got maybe a few states or counties that have one or two, maybe 1 or 2 more months or a few weeks of some of these moratoriums on foreclosures and evictions, but that's all coming to an end, and then we'll really see how the market plays out as the year goes on. All right, guys, that's kind of my thought. So this, again, will be I guess you could say a series of videos based on predictions. Next few videos I'm going to do, probably a handful or so, like a playlist. It does make sense. And again, I keep showing this because this is a really great opportunity to play in the distressed housing market. I've got stuff I'm launching the next week or so that's going to help people learn and do this on a much grander scale. This is what we're looking for. We go after off-market deals that have a lot of things associated with them, whether there's probates or inherited homes or facing foreclosure, code violations, whatever. Homes with the best opportunity to acquire are the ones that have the most sort of stuff or issues with them. And that's why if you spend the time to look for it, again, gethousingdata.com, go to gethousingdata.com to check out that information, which is going to show all these distressed properties. There really is an opportunity here on a very grand scale. And we'll talk about that as well as time goes on. All right, guys. So once again, if you're looking to connect, there's my email. And I appreciate the likes, views, comments. Please share the video with your family and friends. If you're not a subscriber already, please subscribe. I look forward to speaking with you early next week. Take care.